Welcome students, welcome to lecture number 34, where we will be continuing with module number 5, that is deductions under subject direct taxation. Under this module, we have already seen permissible deductions under section 80C to 80U, and we have to see how to compute tax liability of individual and problems on computation of tax liability of an individual. Before that, let us see what is set off and carry forward of losses. So in today's in today's lecture, we will be covering revisions of deductions and set off and carry forward of losses, only theory part. So we know that in order to compute the taxable income of an SSC on which tax is to be liable, we have to take the total of all the 5 heads of income. And from the 5 heads of income, when we add it up, we get the gross total income. Then we have to deduct the deductions under section 80C to 80U to get the total taxable income. So we know that the different permissible deductions under section 80C to 80U are these different types of deductions. So quickly, just let me go through all the types of deductions because this is going to help you all in solving the problems. Section 80C is when an individual or HUF is contributing or making investment in the 22 specified set of investment categories, and like the life insurance premium, contribution to provident fund, tuition fees, etc. And the maximum amount that can be contributed under this section is 1,50,000. 80CCC is where an individual is contributing to certain pension funds that has been set up by LIC, and the maximum amount of contribution again that can be made under this section is 1,50,000. 80CCD is when an individual, either is employed by the central government or any other employer, is contributing to pension scheme of the central government. Okay, and here the deduction will be 10% of the salary or 20% of gross total income, depending upon the situation under which he is employed. Then 80CCE says that the total amount of deduction under 80C, 80CCC, 80CCD should not exceed 1,50,000. 80CCG says that when an individual makes an investment in Rajiv Gandhi equity savings schemes, he's going to get a deduction under section 80CCG. 80D, we know that when an individual or HUF is making payments towards medical insurance premium or he is contributing in the central government health scheme, and the maximum deduction he's going to get is 25,000. But if the senior citizen, his parents are the senior citizen, they will get a deduction of 50,000 instead of 25,000. 80DD is again dependent disability. When an individual or HUF is incurring medical treatment expenses on dependent disabled, then deduction is given. There's a flat deduction of 75,000, and in case of severe disability, the deduction is 1,25,000.
Ma'am?
80D, yes?
Ma'am, in under section 80D, RCC can also claim deduction as if he's a senior citizen, then he can also claim deduction, no?
Yes, he also get, yes. 50,000 will be given even if the individual or his spouse is a senior citizen. So if anyone is falling as a senior citizen, he will get as 50,000, and if they are not senior citizen, they will get 25,000. Taking into consideration this individual, self, spouse, dependent children, everyone.
Okay, ma'am.
Okay. So we were in 80DD. So he is going to get a flat deduction of 75,000, and suppose there is a severe disability. Severe disability means 80% or more he is disabled. He will get a deduction of 1,25,000. Next is 80DDB. 80DDB is a deduction that is given to an individual when he is spending for medical treatment of specified diseases. Okay, and the deduction here is 40,000. And 1 lakh if it is a senior citizen. Next, ATE. ATE deduction is given when an individual is making a payment of interest on loan taken for higher education. Okay, ATDD is an deduction given to an individual when he is paying interest on loan borrowed, okay, for residential house property. For acquiring a residential house property, if he's taking a loan, he's going to get a deduction under section 80EE. 80G is again donation that is made to any four categories by all the SSEs. It is any SSEs making donation in any of the four categories. We know category 1, 2, 3, 4. Category 1 is 100% deduction without any qualifying limit. Category 2, 50% deduction without any qualifying limit. Category 3 is again 100% deduction with qualifying limit. Category 4, 50% deduction with qualifying limit. Now, in the second category, you have all Nehru family. In third category, you have family planning and Olympics. And in the fourth category, you have is minority community. You have temple, mosque, gurudwara, charitable institutions, okay, and for charitable purposes, and etc. And in under 100% deduction, majorly you have Prime Minister's National Relief Fund, Children's Fund, PM Care Fund, which is now recently added, okay, and the remaining which is not falling in any of the three categories will fall in the first category. 80GG, and the qualifying limit you all know is nothing but 10% of adjusted adjusted gross total income. Now 80GG is nothing but when individual who is not getting HRA but he is paying rent for a residential accommodation, it will be covered under section 80GG. 80GGB is when an Indian company is making contribution to a political party, otherwise than by the way of cash. 80GGC is when any person other than local authority or any person which is funded by the government is making contribution to political party. So the deduction amount will be whatever is the actual contribution, but it should be made in any mode other than cash. 80JJAA is again deduction in respect of employment of new employees. So in respect of companies to whom section 44AB tax audit is applicable, they will get a deduction in respect of employment of new employees. 80QQB is given to an individual who is earning royalty income, okay, on the books that he is the author of. So he will get a deduction of 3 lakh rupees or actual income, whichever is less. 80RRB is given to a patentee. Okay, so royalty on patents. If he's earning income by the way of royalty on patents, so the whole of such income or 3 lakh, whichever is less, is going to be given as a deduction. 80TTA is given to an individual or HUF for other than senior citizen for interest on deposits on saving account. So the deduction is given is maximum 10,000. 80TTB is given for a senior citizen, okay, where interest on deposit is given, both fixed and saving account deposit, and the maximum deduction is given as rupees 50,000. 80U is nothing but deduction in case of person with disability. So if he's severely disabled, he will get a deduction of 1,25,000. If he is not severely disabled, he will get a flat deduction of 75,000. So this way different permissible deduction under section 80C to 80U. Now let us move ahead to set off and carry forward of losses. Students, for this particular concept, that is set off and carry forward of losses, you have only theory. No sums or problems relating to set off and carry forward of losses is covered in your syllabus. So first thing, let us understand what is the meaning of set off. When I say set off, what does it mean? Set off simply means adjustment. Now, adjustment of what? Adjustment of losses against the profit. Means you are going to adjust the loss against the profit either from the same source of income or from a different source of income. Now, students, under income tax, what are the different sources of income? You have income from salary, income from house property, income from business or profession, income from capital gains, and income from other sources. So when I say same source of income, that means salary. In case of salary, there is no losses. So when I say same source of income means, suppose if it is a house property, If you have two particular house property, and from one house property you're incurring losses, from one house property you're incurring profits. So the loss of one house property can be set off against the profit of another house property. So when you are setting off the losses against the profit from the same source, it is called inter-source set off. But suppose if you are adjusting the losses against the profit from a different source, so suppose loss from house property, you're going to set it off, suppose against the income from business, then that becomes inter-head set off. Different heads of income we know are 5 heads of income. So when you're setting off the losses against the profits from another source of income or from the same source of income in the same assessment year, it is called set off of losses. And what is carry forward? Suppose if you're not able to set off the losses, suppose there is no sufficient profit among the different source or different heads of income and you're not able to set off that particular loss, you can carry it forward to the next assessment year. So the balance of the loss can be carried forward to the next assessment year. So what is meaning of set off? Set off simply means adjustment of losses against the profit from same source of income or either interhead source of income. Okay. And we know that suppose if losses cannot be set off in the same year, reason being due to ineligible profits, due to that inadequacy of profits, then such losses can be carried forward to the next assessment year for adjustment against the profits of the next year. Okay, so this is nothing but this is the meaning of set off. Did everyone understand what does set off means? Set off will come into picture only when they are losses either under any source or either under any head of income. Did everyone understand set off and what is the meaning of set off?
Yes, ma'am.
Yes, ma'am.
Okay. Now, let us see what is inter-source set-off. Before setting off it against different head, first always you will set off with its own head. Suppose I have a loss from house property. First you will see if I have a profit from house property also from different properties that I acquire. Then only you will go for inter-head set-off. So first always inter-source set-off becomes. Inter-source set-off means set off within the same source of income. So under inter-source set-off, losses incurred by the SSE in respect of one source shall be set off against the income of another source, but under the same head of income. So is this clear? Loss from one source of income can be adjusted against the income of another source of income, but both the sources should be under the same head. See, we know there are 5 heads of income. So when I say loss of business, suppose if I'm incurring a loss from business or profession, when I say I have to do inter-source set-off, then I have to adjust it against the profit of same head, profit of same under the head business or profession. So inter-source set-off simply means setting off the losses against the profit from the same head of income. Then it is called inter-source set-off. Is this clear, students? Did everyone understand what is inter-source set-off?
Yes, ma'am.
Okay, but now there are certain inter-source set-off which cannot be done. Okay, so let us see what are the impermissible inter-source set-off. Like long-term capital loss. We know that in the capital income from the head capital gains, okay, we have a long-term capital gain and short-term capital gain. Now, set-off arises only when there are losses. So we have long-term capital loss and short-term capital loss. But in case of inter-source set-off, long-term capital loss cannot be set off against short-term capital loss, though they are falling under the same source of head of income. See, short-term capital capital loss, long-term capital loss. Both are belonging to which head of income? They are belonging to income from capital gains, correct? But there are certain impermissible set off. Even in the same head, even if they are under the same head, you cannot set it off. And such exception is long-term capital loss. Long-term capital loss you cannot ever set off with the short-term capital loss. But short-term capital loss is allowed to set off against both short-term capital gain as well as long-term capital gain. However, long-term capital loss can be set off only against long-term capital gain and not short-term capital gain. So students, have you all understood what is inter-source set off and what is the impermissible inter-source set off? Inter-source set off is nothing but setting off within the same head of income, not inter-head. When you're setting off the losses against the profit from the same source of income, it is called inter-source set off. But certain inter-source set off are not permissible. And which is that? Long-term capital loss cannot be set off against short-term capital gain. Okay, though they are falling under the same source, it is impermissible. But short-term capital loss can be set off against long-term capital gain as well as short-term capital gain. So did everyone understand what is inter-source set off?
Yes, ma'am.
Yes, ma'am.
Okay.
Yes, ma'am.
There is one more impermissible inter-source set off. We know that in the head profits and gains from business and profession, the business can be a speculative business and a non-speculative business. So loss from a speculative business can be set off only against profit of the speculative business. It cannot be set off against, okay, a income or gain from non-speculative business. So just remember, loss from speculation business, it can be set off only against gains of speculation business. It cannot be set off against gains of non-speculative business. Though speculative, non-speculative business are falling under the same head of income. Which is the same head of income? Income from the head profits and gains from business or profession. But this is an impermissible set of inter-source set off. Next is, we know that income is earned also by owning and maintaining race horses, correct? So loss whatever you are incurring from the activity of owning and maintaining race horses can be set off only against gain from the activity of owning and maintaining race horses. It cannot be set off against income from other sources of income. Though they are falling under the same head, income from other sources. Under income from other sources, you have the gain from activity of owning and maintaining race horses. But remember, the loss from the activity of owning and maintaining race horses can be adjusted against the profit of only from the activity of owning and maintaining race horses and not from any other source of income. So these were all different impermissible deduction under inter-source set off. Next, let us see what is inter-head set off. What do you mean by inter-head set off? Inter-head set off is nothing but, students, where loss under one head of income can be adjusted against the income from another head of income. So under inter-head set off, you will not set it off within the same source of income. You will set off the loss of one head of income with the profit of another head of income. And we know we have 5 heads of income. So let us see loss under any head of income other than capital gains. So where the net result after computing the head of income other than capital gains is a loss, the SSE can set off such loss against his income assessable for assessment year under any head, including capital gains. So suppose if any head of income, there are 5 heads of income, okay? other than capital gains. So leaving capital gains, if the four heads of income, if there is a loss, the SSC can set off such loss against any other head of income. Okay, exception capital gains. And even in case of loss from profits and gains from business or profession, such loss cannot be set off against salary. So there are certain impermissible provisions that is given that you cannot do interhead or intersource set off for few listed sources of income or heads of income. So first is capital gains, second is profits and gains from business or profession cannot be interhead set off with income from salaries, and under capital gains where there is a capital loss, such loss cannot be set off against income from any other head. So we will in short see in the very next slide what can be set off and what cannot be set off under a particular head. So students, for now, did you all understand what is intersource set off, what is interhead set off, and what is the meaning of set off? Is this clear to you all, students?
Yes, ma'am.
Okay. Now let us see in a form of a table that what is allowed to be set off and what is not allowed to be set off. So see, loss under the head house property. It can interhead loss, intersource we know what all is not permissible. Now interhead, let us see. Loss under the head house property can be set off against salary, can be set off against house property, can be set off against non-speculative business, can be set off against speculative business. So can be set off. So loss under the head house property can be set off against any head of income. Now in, we know there are five heads of income. Let us see that. Income from head salary, house property. In case of profits and gains from business and profession, the income is divided into non-speculative business and speculative business. In case of capital gains, it is divided into long-term capital gain and short-term capital gain. And in case of income from other sources, you have owning and maintenance of race houses and the others. So these are the different five heads of income. So loss under the head of house property can be set off against any head of income. Next, speculative business loss. It can be set off only against gain from speculative business. It cannot be set off against any other head. Remember students, speculative business loss can be set off only against gain from speculative business. It cannot be set off against any other head of income. Next, other business or professional loss. When I say other business or professional loss means non-speculative business. So as I already told you all in the earlier slide that other business loss can be set off against any head of income but not against salary. So business loss cannot be set off against salary, but it can be set off against any other head of income. Next, long-term capital loss. As I told you already earlier that long-term capital loss can be set off only against long-term capital gain and not against any other head of income. Similarly, short-term capital loss. Short-term capital loss can be set off against any, cannot be set off against any head of income, but can be set off only against long-term capital gain or short-term capital gain. Next, loss from owning and maintenance of race horses cannot be set off against any head of income, but can be set off only against owning profits from owning and maintenance of race horses. So students, this is nothing but this chart is showing us that under the different heads of income, what is the set of possible and if possible under which source of income. This I have already explained in the previous slide, okay, but this is just a table depicting whether the set off is possible or no. So is this chart clear, students? Yes, students?
Yes, ma'am.
Yes?
Yes, ma'am.
Okay. Now let us see the carry forward of losses. We have completely understood the set off part. Under set off, we have understood what is the meaning of set off, what is inter source set off, what is inter head set off. Now let us understand carry forward of losses is nothing but when a loss of a particular, when the profits of a particular year is insufficient, so the loss cannot be set off, the loss has to be carry forward. And if it has to be carry forward, for how many years can you carry forward the loss? So let us see that. Okay, students, so we have to see what is the nature of losses, all these nature of losses, and up to how many years it can be carry forward. So if it is an unabsorbed depreciation, what do you mean by unabsorbed depreciation, students? Depreciation you charge in the debit side of P&L account, but what if the profit of that particular year is very less, so that you cannot allocate the depreciation? So if the depreciation is not able to be allocated or absorbed against the profit, because the profits are insufficient, then you will have to carry forward the unabsorbed part of the depreciation. So unabsorbed depreciation you can carry it forward, okay, for indefinite period of time. That means the unabsorbed part of depreciation you can carry forward for n number of years. There is no specified number of years for which you have to carry the unabsorbed depreciation. Next, unabsorbed loss from house property. When I say unabsorbed, it means that because the profits were less, the loss couldn't be absorbed from that particular source or from that particular head. Okay, so unabsorbed loss is a loss which is not absorbed against the profit. So unabsorbed loss from house property, it can be carried forward for a period of 8 assessment years. So for a period of 8 assessment year, you can keep on carry forwarding that loss, and then you can keep on doing inter-source set off, inter-head set off. It is, if it is able to be set off against the profit, well and good. If not, then carry it forward for 8 assessment years. Next, unabsorbed business loss. Unabsorbed business loss, again you can carry it forward for 8 assessment years. Is this clear? Okay. Income from speculative business. See, income from the head, profits and gains from business and profession, under the set off and carry forward provision, it is to be divided into two parts: speculative business, non-speculative business. So loss from speculative business can be carried forward from for a period of 4 assessment years. So for 4 assessment years you can carry it forward. Now, loss from the specified business under section 35 AD, you can carry it forward for indefinite period of time. Now, here it started, students, it started with income from house property. They have not started with income from salary. Reason being, there cannot be a loss from it, from the head salary. So salary is something that you're going to receive. So you're not going to incur a loss under the head salary. That is why that is not mentioned here. So it is starting with house property, which can be carried forward for 8 years. Business, again speculative, non-speculative. It is non-speculative, it can be carried forward for 8 years. If it is speculative, it can be carried forward for 4 years. Then loss from a business, that is specified under section 35 AD, for indefinite period you can carry it forward. Next, long-term capital loss. If it is a long-term capital loss, it can be carried forward for 8 assessment years. If it is short-term capital loss, you can carry it for 8 assessment years. And loss from the activity of owning and maintaining race horses, it can be carried forward for 4 assessment years. So this, you all know what is the meaning of carry forward, means taking the losses to the next year. And for how many periods? for how many assessment years it can be carried forward. Next we need to see is, once they are carried forward, under what head of income can they be set off? So first we have seen the years. Now let us see income against which the brought forward losses can be set off. So if it is unabsorbed depreciation, it can be set off against any head other than salaries. Why? Because depreciation usually comes under business part. So business loss can be set off against any head other than salaries. Unabsorbed loss from house property can be set off, you carry it forward, and once you carry it forward you can set it off against income from house property only. Unabsorbed business loss, once you are carrying it forward, you have to adjust it against the profits and gains from business or profession. Loss from speculation business, you have to carry it forward, you can carry it forward for 4 assessment years, but that loss has to be set off only against income from speculative business. Similarly, loss from specified business under section 35AD, you can carry it forward for n number of years, but you can set it off only against profit from specified business. Next, long-term capital loss, you can carry it forward for 8 assessment years, but when you're carrying it forward, you can set it off only against long-term capital gains. Similarly, short-term capital loss, you can carry it forward for 8 assessment years, but you can set it off only against long-term capital gain or short-term capital gain. Similarly, loss from the activity of owning and maintaining race horses, you can carry it forward for 4 assessment years, but you can set it off only against income from the activity of owning and maintaining race horses. Now, what is the order of set off of losses? How are you going to set off the losses? So suppose if there is a brought forward a loss of depreciation. So first, are you going to set off the current year depreciation or current year business loss from business or profession? What is the order of set off? So order of set off will be always first set off current year depreciation or current year capital expenditure on scientific research or current year expenditure on family planning to the extent allowed. So always whenever you start fresh with an assessment year, first current year depreciation has to be set off, not the brought forward depreciation. Second, after setting off the current year depreciation, you are going to set off brought forward loss from business or profession. After that, if still the profit is remaining, you are going to set off unabsorbed depreciation, fourth unabsorbed capital expenditure, and fifth unabsorbed expenditure on family planning. So this is the order of set off. You are not going to first set off unabsorbed depreciation. First should be current year depreciation, then brought forward losses, then unabsorbed depreciation, then unabsorbed capital expenditure, and then unabsorbed expenditure on family planning. So this is the theory part relating to inter-source and inter-head set-off. So students, have you understood what is the meaning of set-off? What is inter-source set-off? What is inter-head set-off? What are the impermissible inter-source and inter-head set-off? What is the meaning of carried forward of losses, and for how many years the losses can be carried forward? And if carried forward, with against which source of income? And what should be the order of set off? Is this clear, students?
Yes, ma'am.
Okay. So by this we have completed the set off and carry forward of losses, the theory part, which is as per your syllabus, and the problems. Now under this module we are just pending with the problems on computation of the tax liability of an individual, which will be covering in the next lecture. So thank you so much, students.
Thank you.